Hello, everyone, and welcome. So, my name is Marcus Ingram from Tools for Brokers London office, and today I'm going to be showing you what brokers told us are their biggest operational pressures in 2026, where they are investing to solve them, and what the firms that are succeeding are doing differently. This includes using technology to improve their operations, manage their risk better, and generally offer a better experience to their clients. We have collected information from our clients across our UK, Cyprus, and Asian offices on both their biggest challenges and their top planned tech investments for the upcoming year. Today's webinar is going to be centered around the findings from these surveys, as well as case studies related to the specific priority topics. Yeah, as a quick run through of the agenda, we're going to be covering the results of the survey first. So two of the topics for today are the biggest challenges they're facing and the top planned investments. Then for the highlighted topics, so the topics that performed the best or were highlighted the most from the surveys, we're going to be going through these individually. So these are risk management, scaling, automation and AI, and the complexity of the tech stack. For each of these, we're going to be doing a case study of a real example of how clients have solved these specific issues. At the end, I'll be happy to go through any questions you have. Just write them in the chat and we'll cover them at the end in the Q&A section. So yeah, if we look at the biggest challenges, what I think is interesting here is how concentrated the data is. So from the brokers we spoke to, over half of them are focused on just two things. So these are risk management and scaling. I think this makes sense because almost everything else we'll go through today stems from these two pressures. But what this really shows is that organizations are focusing on prioritizing both operational stability and growth. If we look at the planned investment priorities, uh, unsurprisingly, AI is at the top of the list with over a quarter of the responses. But the next three that follow are all related to back-end operations and stability. So there seems to be less of a focus on UIs and front-end tools for client experience and management, but instead focusing on the foundations that make a brokerage's operations solid. So yeah, with the volatility we particularly saw in 2025, especially with regards to gold and silver, it's no surprise that risk management is sitting at the top of the agenda. So I'd say volatility itself is becoming less predictable and less seasonal. So in the past, it would arrive in these more cleanly packaged bursts, so around things like central bank events or big economic news. Now it's becoming more of a consistent feature of the market, a lot more random and more sporadic. And this changes how a brokerage needs to operate. The pressures they have on margin, on exposure, and on their internal book are now continuous rather than only in certain times. So we have to be prepared at all times since these events are a lot less predictable. On top of this, traders are behaving differently as well. So not only are they better equipped with information and tools, but also narratives are spreading faster, and this affects not only how people trade, but what they trade. As I mentioned, a good example of this was what we saw recently with gold. And there are two main considerations for risk management here. So one is in that case that we had recently where the vast majority of positions opened are longs, but also the effect of a sudden price surge or a sudden fall for those brokers that are internalizing the majority of their flow. If traders are heavily skewed in one direction and the market runs in one direction, exposure can accumulate very quickly, and manual monitoring or legacy monitoring systems often can't deal with it. Even if we're to hedge, kind of follow the conventional wisdom of hedging this flow at the LP, the risk isn't always completely transferred because it's common that the trader is being offered much higher leverage than the broker is getting themselves at the LP. What I'd say here, though, is it's important that this is more of a reaction time problem than a risk problem. So when data is delayed, scattered, or um, entirely managed manually, it can be hard to respond in time. And the firms that cope best with these market conditions are the ones that can see in real time their exposure building live, but also understand the concentration of risk that they have. So the symbols where risk is accumulating, the client sections or groups where risk is accumulating. Um, if they have both of these things, they can implement changes either automatically or without too many steps. It's important that volatility isn't a bad thing, of course. It brings good opportunities for revenue. So good risk management isn't about avoiding risk entirely, but capturing only the risk you intend to take. So yeah, how can we best utilize technology to deal with these risks? So here's a case study from one of our clients that we worked with. So we had a client that was using manual processes for all of their risk management, which got exposed by the growing volumes and the existing market volatility that we saw recently. What this led to was an unmanaged B-book exposure, and they were particularly prone to risk around news events. So what did we change for this firm? So we focused on the process, and the first step was to introduce automated hedging. This didn't mean completely removing human oversight, but instead setting limits and rules in advance, which essentially would set the max capacity for the risk they would like to hold. So when exposure hits a certain threshold or their risk was to concentrate, their systems would immediately act rather than waiting for someone to intervene. Similarly, we also set up exposure limits, which are basically guardrails for their risk. When we are to structure these by symbols or by groups, there's a lot less panic when the market suddenly jumps in one direction. So both of these things are essentially there to set up risk tolerances for the unexpected volatility or exposure. We also use for them liquidity aggregation because the larger your client base is, the more the execution quality you have matters. So using multiple venues for pricing or for feeding not only improves the pricing itself from having a deeper book, but also adds an additional level of stability as you can use backups or different sources that you can switch to easily. Um, as a result of this, their book was a lot more predictable in how it would behave under stress. Risk was kept within these predefined limits, and even if there was this unexpected volatility or random market events, they were able to maintain the same execution standards without having a big effect on their risk book. So the second and kind of ever-present theme is to do with scaling. So that's bringing in, of course, more clients, more volume, or just in general having a wider reach. But the real question, I think, is how do you scale without creating more new issues than new revenue? So I think when we look at scaling, it's important to think about it in two different parts. So firstly, the methods we can use to scale, and secondly, whether our systems are ready to support that growth. As for the methods, growth doesn't necessarily always mean finding more new traders. Of course, the marketing can play a role. So if we use things like social media marketing, IB networks, it's a great way to find the right new audience. But what we're increasingly seeing is a focus on getting more value from the existing client base. So this involves retention, encouraging more trading activity, and just that general idea of creating a longer lifetime value per client. I think it's equally or even sometimes more important to keep the traders you have engaged and satisfied. Another way to do this would be to expand the product offering. And I think this is something that the prop trading section of the industry has done very well. They have structured basically a different product that resonates very well with a new group of traders or an entirely different trader base, depending on how you look at it, which essentially is just bringing new people into the industry. Of course, this would be one way, but I think a similar thing can be done by adding new platforms, new asset classes. So, for example, we're seeing a lot of interest in futures and options at the moment, and the kind of overlaps with that with the CFD space, just as a way to bring in people with new faces or different risk appetites as a potential client. Um, Lastly, of course, we see people look towards new regions, so setting up satellite offices there. So this does bring new challenges with the different languages, different payment preference, or different effect on risk as the clients behave differently. But of course, there still represents a great opportunity. Yeah. But I think the part that often gets overlooked is being set up in the right way to deal with this growth. So when these strategies do work, can our systems handle this with no issues? And the brokers that scale most comfortably are the ones that invest early, probably oftentimes before it is needed, in the right foundations. So having systems properly integrated, automating repetitive tasks, and making sure the whole trading infrastructure is ready for the increases in volume. The idea here is basically to ensure that processes that are working at 1,000 or 100,000 clients will still work at a million, etc. So yeah, here is a real example of scaling that we had. For this client, the introduction of copy trading strategies was a big growth booster for them and really accelerated their growth. Essentially allowed them to attract a new section of the market as they were catering to these newer or less experienced traders. And the copy trading itself was lowering the barrier to entry for them. But this added a new type of risk pressure since the copy trading created synchronized trading. So not only were they experiencing a spike in overall volumes, but the market volatility we saw last year was amplifying that concentration risk they had from the copy trading. So yeah, what we did was focus on three core improvements. So the first was to establish a stable, centralized oversight. So rather than taking information from multiple sources and tools, one interface was used for to give them essentially a real-time picture of their flow and their exposure. We also did a proper audit of their infrastructure to check for things like shared vulnerabilities in their hosting, backups, and failovers they were using. What we found from that was that latency could be improved by just changing their data centers for hosting and having everything hosted closer together. And also that their environment could be made more stable by moving backups in order to not have one single point of failure. So not to have the main and the backup server within the same um, geographical region. They also implemented execution rules with a clear logic about what should happen with these concentrated trades from copy trading. So when they should internalize the flow, when they should hedge, and essentially how their routing should behave under different market conditions. This was done using predefined risk limits, which are essentially agreed upon boundaries that reflected their risk appetite. So essentially, there wouldn't be any surprises no matter which way the market went or the way the market behaved. The outcome of this essentially was that their risks were reduced, even though their volumes kept climbing. And they were able to keep their low latency execution even during active periods. So this was providing a stable offering that their clients could trust, and essentially meaning that the new traders that they acquired were satisfied and were keeping their business with them. Yeah, the third trend I want to talk about is AI and automation, which understandably I'd say is the top planned investment from our survey, which is no surprise since it's everywhere in conversation at the moment. But I think it's interesting to look at how adoption has actually happened so far, and then of course the ways it will be further utilized in the future. So far, I'd say it's been more about using technology to assist or perform repeatable work, so already existing tasks, with the idea to speed up these existing processes without completely reinventing them. So in other words, essentially automating first. And I think this makes sense because many brokerage operations are full of predictable or repeated processes. So things like updating swaps, dealing with corporate actions, or internal reporting, or regulatory reporting. So this first wave of AI in our industry has really been about systems doing these structured tasks so that people can instead focus on the judgment decisions that come from it or the exceptions to the rule. And I do think this is already delivering great value in terms of the time saving and efficiency. But some of the AI layering we're already seeing is in supporting the decision making itself. So not replacing risk or dealing teams, but instead providing them with the context they need faster. So things such as highlighting unusual changes in trading behavior, spotting common trends and themes, or alerting on abusive or toxic activities. Instead of having to hunt away in the data for the insight, it's already made clear to you. So as of now, humans are still deciding, but with a lot less visibility. Sorry, a lot better visibility. So yeah, what does the current state of automation and AI typically look like in our industry? So before, firms depended a lot on manual monitoring. So I'd say the best questions to ask to best utilize this technology are what behaviors are we constantly or frequently looking for that could be automated? But also, what actions are we looking to pick up that, once discovered, might require escalation or further action to be taken? Once this itself is clear and defined, automated alerts can be set to pick up on these activities. And this is just a way of improving the quality of the internal conversations you're having. As instead of thinking about, is this behavior strange or is this abnormal? Instead, you can just discuss what to do about it, which adds a lot less um, time to the response of actually dealing with these things. I think the next stage that is already underway is automating the reaction to these things. So once an account is flagged, it can be routed differently, it can be marked for review, or it can be handled under a specific risk profile and moved to that risk profile. And in 2026, we are already seeing a shift from using AI as this analytics tool to becoming operations. I think the main advantage here isn't just the speed, but also the consistency and the scalability. So the more machines are able to perform these tasks, firms will be able to grow without the proportional headcount increasing. So yeah, the fourth trend here is often why a lot of the other problems exist in the first place, and that's because technology has become too segmented or too complicated. So I think the common narrative here is that over time, firms are adding solution based on their immediate needs, and each individual decision, of course, makes perfect sense at the time. So we have an issue with risk. We had a risk tool. We had a client onboarding situation we need to improve. We had that. But after some time or some years, what you're left with essentially is many individual parts rather than a um, fully cohesive ecosystem of tech. Um, and having multiple systems increases both cost and risk. So cost in the sense of having to pay multiple vendors and often use a large amount of internal resources just to keep everything working together. But risk in the sense of having data living and existing in different places. If the numbers don't reconcile straight away and internal teams are relying on exporting this data, adjusting it themselves, or manually collecting this data from different sources, um, that affects risk by slowing the reaction time to deal with things. The cost can here sometimes can be hidden as the impact on a client's onboarding journey, for example, can be harder to quantify. But definitely the impact of having, say, for example, a segregated and a long and impractical onboarding process shouldn't be underestimated in terms of revenue. The two main focuses of simplification. I'd say the two main focuses of simplification should be making systems work better together and improving the experience for the clients. So essentially for making as few steps, as little friction, and as few clicks for the client as possible. For example, with a PAM system, the same portal ideally should be used for everything. So the depositing, withdrawing, connecting, KYC checks, everything that the client eventually would need to do. And for this to be achieved, we need to be working towards having one connected setup. So this involves full integrations via APIs, integrated payments, and all of the systems sharing data smoothly as possible. Especially when with a multi-platform setup or multi-server setup, I'd say the main things to focus on centralizing are the client onboarding, the risk management, and the liquidity and the execution, which if we are to centralize these things, you'll have one common portal to visualize everything that makes managing this kind of setup much more straightforward. In general, the goal for adding technology and using technology should be to make life easier for clients and clearer for the risk and dealing teams. And I think a properly integrated ecosystem offers exactly that. So yeah, as has hopefully become clear from what we have covered so far, none of these goals or challenges are living in isolation. So the risk, the scaling, automation, AI technology, they're all very much interconnected. And this all starts with the growth. So as volume increases, risk exposure naturally does too. There's more positions, more threats to be aware of. So growth is immediately putting pressure on risk management. In order to handle those risks, firms look towards automation. So good automation requires um, connected systems and proper integrations. But when this is done well, it reduces the manual effort needed and makes operations significantly more efficient. And then the next and already beginning stage is using artificial intelligence and advanced analytics in order to build on top of these already solid foundations. So right now, it's supporting better decision making, but in the near future, and we're kind of already starting to see elements of brokerage being run purely by machines and AI. So yeah, what should brokers do now? So I think it's important to clarify some questions internally. So can we handle volatility, or is this causing us big issues on our risk book? Do we currently have the right means to scale effectively, or are things getting more inefficient as we scale? And of course, are we investing intelligently in the right technology for us? We have also prepared a report on the full survey from brokers we work with across Europe, MENA, Asia, and the actions that these brokers should take. And I'll share at the end of the Q&A exactly where you guys can get that from. Of course, some brokerage challenges are the same, but everyone's situation is slightly different. So if you're looking for specific assistance with any of these challenges, feel free to reach out to myself or via our website for more information. So yeah, now we'll go through. I see we have some questions already, but feel free to write them in now if you have any as well. So yeah, we have a question on if there are any cost-effective ways to test before fully implementing systems. And I say, yeah, generally the majority of technology you can get a free trial for. And for the core tech that needs to be integrated with anything else, you're normally able to get the API specs for integration. So oftentimes the most effective way, especially if you have a time limited free trial, would be to go over the integration specs first. So you could be able to fully effectively use um, the free trial you have for pure just user testing rather than the integration itself. So we have a question on our services and the costings. So we do offer several things for brokerages in terms of risk management, automation, infrastructure. But of course, the costing is very dependent on the individual case and exactly what you need. So I'll make sure myself or one of our team contact you after this meeting to discuss that in more detail. So yeah, in terms of the white paper, so as I mentioned, we have collected the survey data from the clients across offices, so across our UK, Cyprus, and our Asian office in Singapore. We have the So yeah, we have the 200 clients from five different offices, and these clients are spread across the world. So if you would like this information on the white paper, um, for the webinar users, this will be sent for you straight away. But of course, you can also contact us via our website using the sales email here. But yeah, thank you everyone for joining. I hope this was useful and hope you have a good rest of your day. Thank you.